Well, if you have a mortgage, you're interested in what happens with interest rates, and you'll know that the Reserve Bank yesterday made a decision and an announcement to leave the cash rate unchanged at 2.75%. There had been some economists who had been estimating, or who had been predicting that it could drop down another 0.25%, though most were saying that it would likely stay the same. To talk about interest rates, yesterday's decision from the Reserve Bank, let's have a chat to our finance guy, Gavin Martin from Cornerstone Wealth. Hello, Gavin. Welcome back to 2020.
Oh, hi, Neil. Great to be with you again.
Gavin, always interesting, particularly if you have a mortgage, you're interested in what happens with interest rates. Well, yesterday's decision, leaving the interest rates on hold, is that good news for people in the housing market?
Definitely those people with mortgages, it's probably not the best news because they would have liked an additional reduction in their mortgage rate. But for those people that are on pensions, that are self-funded or earning interest on their money, then actually it's quite good news because they won't see their interest rates drop another notch over the next little while. So depends on what your particular situation is. But I guess the good message that comes out of the good news message that comes out of it is that the statement by Glenn Stevens, the Reserve Bank governor, was that the sum of all the economic indicators, they're comfortable with how things are at the moment. So you can see that it could, because if interest rates drop, then it might be seen as, things are looking quite bad and challenging, but they're quite comfortable with how things are tracking at the moment, both globally and in Australia.
That's the interesting thing about interest rate time each month, is that there's a real story to tell whether interest rates rise, whether they fall, or whether they stay the same. And as you're saying, the Reserve Bank is comfortable with the economic indicators, and to the point where they're saying, well, it's time to leave them on hold.
Time to leave them on hold, but I think for the last number of announcements, they've put this last little clause at the end of their statement, which says that there's capacity, should they need to reduce the interest rates lower. And that's a position that not all countries have. You have countries like the US with next to zero interest rate levels, and so they haven't got any scope to go any further down in their interest rates. So that's something that the government in Australia the Reserve Bank in Australia does have the opportunity to do, to reduce things further should we get into further difficulty. But they're suggesting that the rest of the year will be a below trend growth, and then after that we should see some more growth towards trend after that in the following year.
And what might that indicate, Gavin? Because if we're talking about a return to growth next year, is there likelihood then that there might be pressure on interest rates to rise?
Yeah, that could actually be the case. So as we see the economy start to grow, inflation might start to pick up, and then they'll start to think about, well, are we a little bit aggressive in terms of, are the interest rates too low? Is it too stimulatory? And are we going to cause a bubble in some areas of the economy? And then they'll start to think about increasing those as well.
For people who have a home mortgage, that question arises whenever you start talking about interest rates. Is this a time when you should lock in your interest rate to a fixed interest rate, or just leave things variable? What are your feelings on the general overall about direction when it comes to locking in your home mortgage?
Yeah, I see locking in a fixed interest loan as really risk mitigation. So often the way to go is to do a partial fixing of your loan. So you can do, if you've got the average mortgage, I think is around $300,000. If you locked in, say, $200,000 for a time, then that might be a reasonable thing, knowing that you can potentially pay down the other $100,000 should you receive additional bonuses or come into money somewhere. But you also need to think about not just the interest rate that you're going to lock into, but also the further ramifications of it, because when you lock in a fixed interest loan and then, for example, you need to move house and need to sell the house, then you've got to think about the break cost of that as well. So there's not just the interest rate to factor in, but also the potential costs of breaking a fixed interest loan should your circumstances change and you need to move home.
Now, others are affected by interest rate decisions, and yesterday's decision to leave rates on hold, how does that affect people who are relying on their investment income to survive. How are they feeling, do you think, at this time?
Yeah, people who are relying on interest income for their living requirements have been doing it tough. They've seen the interest rates drop significantly over the last 12 months, and where they will have potentially have got over 5%, they're now getting 4% or below in terms of their earnings. And so more and more people in that boat, as they are seeing their fixed interest investments come to maturity, they're thinking, do I lock in for another 6 or 12 months at 4% or thereabouts, or do I put it into a different investment, potentially the share market, for example, and get a 4% yield with the idea that they might get more in capital growth as well. But like all investments, risk and return are related, so going down that track does involve more risk, but you really need to assess whether you're going to eat into your assets too much if you do just leave your money in the fixed interest investments at such low rate.
Well, Gavin, with yesterday's decision to leave interest rates on hold, the dollar actually took a bit of a tumble after that decision was made. It's been on a downward trend. What are your thoughts on where the dollar's going?
Yeah, interestingly, in the statement by the Reserve Bank Governor Glenn Stevens, he actually mentioned that there are signs that the Australian dollar is still at higher than what's reasonable levels. So I guess the expectation is over time that the Australian dollar should fall, particularly with commodity prices falling, with, I guess, global growth stagnating a little bit. But the other reason for the Australian dollar going down is that the US economy has been improving, with, I think, real estate valuations, residential real estate going up by around 10%. And so it's because of the US economy, not just because of the Australian economy. But the other underlying factor there is that there's the interest arbitrage. So if Australia has a 4%, if you're going to get 4% on fixed interest investments in Australia and you can only get 2% in the US, for example, then there's the arbitrage of people borrowing in the US and investing in Australia and getting the benefit of those higher interest rates. As our interest rates fall, that benefit, that arbitrage reduces, and therefore there's less desire or less demand on the Australian dollar, which also makes it increase as well. It makes it decrease further as well.
Well, always good getting your thoughts on what's happening financially, Gavin Martin, and I'll point people to your website at www.cornerstonewealth.com.au. And Gavin, just to mention to listeners that your advice is general in nature and people should see their financial advisor to take any personal circumstances into account. Gavin Martin, it's been a pleasure. Thanks for being with us again today on 2020.
Yeah, great to be with you, Neil.